Hi there, everybody. My name is Jason Gold, and I'm back with another episode of Investor Insights. In today's episode, we're talking about the difficulty that many founders face in making the transition from being a private company CEO to being a public company CEO and all the pitfalls that go along with it. So let's get started. So as many of you know, I spend a lot of time with technology companies. And within tech, there's tons of founders. And these are really talented business people. But sometimes they're completely clueless about what it takes to run a public company and how investors think. And over again, it creates opportunity for me to help these companies. So what I'd like to do is help educate other founders and help them from making the same mistakes that many of these other companies have made. See, by the time you call me, things are already in trouble and I can help fix them. But not everybody has to suffer that fate. You can learn from what many of these founders do wrong so that you stay away from the grips of Wall Street short sellers and your story continues to get the benefits and the valuation that it deserves. Let's dig into a couple of the reasons why. First, I want to start with an anecdote about my dad. My dad was a doctor and he went to medical school and did residency and fellowship and he went to work every day. And then he would come home after a day of work at the hospital and he would open up his trading account and he would proceed to lose money every single day. And then he'd call me and say, "What should I do, Jason? You're the business guy. You're the stock guy. Help." And I would say to him, "Dad, you went to medical school. I went to business school. I don't go to work every day and then come home at the end of my day investing in companies and then cut open my family members, have them bleed out on the table, on the couch, and then call you and say, 'Dad, what do I do? They're bleeding out.'" The reality is, I went to school for what I do, and I practice it all day long, and I learned from some of the greatest investors of our time on what to do and what not to do. You went to medical school, and you did fellowship and residency, and you studied from the greatest minds of your time on how to treat people's illnesses. You do you, and let me do me. What's the relevance of this story? Founder CEOs have developed amazing companies. They are visionaries. They might be great coders or chip designers or just fabulous business leaders. But managing a public company and dealing with investors is a totally different discipline. And it takes a very different way of thinking and acting than the founder CEO has acted from inception through IPO. It's because public market investors are super different from the VCs and the PE firms that this founder has had tremendous success with up until now. Think about it. Founder CEOs have defied all of the odds. They came up with an idea, and then they convinced round after round of VC and PE buyer to buy their stock. They sold them the world. They showed them terrific, grandiose projections of how their company was going to run the tables. And there was no penalty for overpromising. In fact, that is a prerequisite for raising money from venture capitalists. Show them how you are going to conquer the world. Thing is, public markets investors don't think that way. They want you to underpromise and overdeliver. That's a very different mindset than raising money from venture capitalists and PE firms. Raising money from public markets investors, they want you to conquer the world. Make no mistake, both sets of investors want you to do the same thing. But how they receive the information is very different. The street wants you to underpromise and overdeliver and give them a beat and raise cadence. No VC needs a beat and raise cadence. If that happens, it happens by accident. It means that the business is growing so quickly that even the founder's most bullish projections were wrong. The reality is the mistake that founders make is being too bullish with public market investors. And I'm here to say, don't do it. Also, humility goes a long way in the public markets. But humility gets you nowhere with venture capitalists and PE firms. Now, make no mistake, I'm neither a venture capitalist nor a partner to PE firm, so I don't want to claim to understand exactly how they think. But the reality is, they like to invest in very aggressive stories. public markets investors want to hear you be a bit more demure, a bit more reserved. You can be excited about what the future holds, but keep some in your back pocket. Keep your cards a little bit closer to the vest. Play it a little bit more conservatively. Don't show everybody the 4 aces you've got in your pocket. Give them to the street one at a time. And with each time, tell them, well, you know what, we feel really good about things, but there's still a bunch of unknowns out there. Let's see how the future plays out. It's okay to be conservative. And in fact, I encourage you to be conservative with public markets investors because you just never know what's happening. And if you've given guidance for the full year, you're going to blow it away anyway if you deliver on your plans. So at least at the start of the year, only let a little bit out and a little bit more out in the second quarter. If your business is really firing on all cylinders, by the time you produce Q3 and Q4 numbers, you're going to blow them away. You didn't need to shout from the rooftops about how great things were right when you reported Q1. Now, again, these founders have been raising money from VCs and PE firms for many, many rounds and many years. Maybe, just maybe, they listened to their investment bankers and the investment bankers convinced them to cut the numbers down at the IPO. But maybe that conservative investment banker didn't win the business, or B, management didn't listen to them. That happens all of the time. And that's when stocks break deal price. Realize the bankers aren't your friends. By the time you report your first quarter out of the IPO, the bankers don't care anymore. And their bank isn't even supporting the IPO price of the stock. They've earned their fees, and they've moved on to something else. The bankers aren't your friends. Now, sometimes they give you good advice, but take it. They're not going to pound it into your head the way I am. I tell my clients all the time, keep some in reserve. Don't show them all of your cards. Give it to them a little bit at a time. Founders can't help themselves so frequently, and it always comes back to bite them. And the founders that are successful the first couple of quarters doing that, they're the ones that fall the hardest in the third and the fourth quarter because the shareholder base has grown accustomed to their beat and raise cadence and think it's going to last. And if they were too aggressive right out of the gates and all of a sudden the magnitude of the beats begins to come down, or God forbid they miss numbers, that's when stocks get cut in half in one day. And the reality is it's much harder to fix a company after the stock's been cut in half. I actually had one client hire me. The CFO called me and said, I want to hire you because I know you won't be a yes man to our CEO. See, what happens so often is these founders surround themselves with people who become yes men. They don't do it on purpose. The reality is sometimes they have a very good CFO, a very good and experienced IR person, and they voice their concerns to the CEO. And after 2 or 3 times of the CEO saying, sit down and shut up, we're going to do it our way, what do? They sit down and they shut up and they become yes people, even though they know it's not the right thing. That's because they like their job, they got bills to pay, they've got mortgages and families, and they don't want to lose them. So what happens is the CEO becomes surrounded by people that endorse his overly bullish attitude. And they call me because I don't mind telling it right to their face. This isn't going to work. You need to cut those numbers down. Even if it means some short-term pain, you will win in the long term by getting rid of that founder mentality of always being too bullish and taking on some more humility and public market savviness. And when they brought me into this client, I sat down with the CEO and I told him, your overly optimistic attitude's actually working against you. People don't believe you. Every time you talk to the street, you tell everyone just how great things are. And by the way, we're in the midst of a very difficult business climate. How could things always be amazing for you? Why don't you at least acknowledge that sometimes things aren't so great? That humility, that transparency, that realness is something that the street actually values. The street is a bunch of people. They know that things aren't always amazing. And by the time they've invested in you, they've invested in hundreds of other companies. and they've been burned. And they know that not every quarter, not every month, not every product release is always going to be perfect. So when you tell them that everything is always amazing and great and the best ever, they stop listening to you and it works against you. Investors tell me all the time, the street tells me all the time, that guy's too bullish. Actually, I've had many sell-side analysts talk to me about CEOs and say, when that guy steps down, the stock's gonna be up 20% because the street doesn't trust him. Don't let that happen to you. Why do you need to be the one that's embarrassed by having their stock go up 20% when you announce your retirement? Don't be the guy that's too optimistic. Instead, be real, be humble, acknowledge the competition, tell people the puts and the takes about your business. It doesn't always have to be great. You can make that transition from being super bullish and optimistic all the time with your VC investors to being a real person and being a little bit more conservative and humble in the public markets. And the reality is, the best leaders surround themselves with people smarter than them in different disciplines. Be that person. Surround yourself with good IR people, good CFOs, good IR consultants who can educate you on how the street works. You might be amazing at running your business, but the reality is maybe you don't have experience as a public market CEO. And so now you need to surround yourself with people who do have that experience, who know how to tone down the message. My conclusion is this: making this transition from private markets to public markets is difficult, but it's not impossible. Surround yourself with people that know what they're doing, that can help guide you through this process and tone down the bullishness, tone up the humility, and the street will reward you. Be a little bit more conservative, or actually be a lot more conservative than you were as a private market CEO, and you will get all of the benefits that you're looking for. Your stock's not going to go up to your target price in one day. This is a marathon and not a sprint. And once you acknowledge that it will take time to win the hearts and minds of people, and that they will do it by you being conservative and under-promising and over-delivering, that's when you will win, and that's when your multiple will really reflect your true value. Thanks again for tuning in to another episode of Investor Insights. My name is Jason Gold, and I look forward to seeing you back here again next time. Thanks so much.